Hello, everybody. I hope you're all doing well, and welcome to another Accounting After Dark with Tchaikovsky. It's After Dark because I don't own the rights to this. In any event, let's take a look at this exercise. So we're getting into now revenue recognition. Revenue recognition has a few additional steps that we didn't do before in financial accounting, but essentially what we're really trying to do, and I may have the ordering this out incorrectly, but we have to get the contract. What's the contract between the parties? The second step is going to be to identify the consideration. The third part is going to be to identify the performance obligations. The fourth step is going to be to allocate the consideration, basically, which is the cash, to the performance obligations. And then lastly is to recognize the revenue. So for this one here, my approach is going to be a little bit different than what you're going to see in the textbook solution, but we're coming up to the same answer. So here we have Geraths Windows manufactures and sells custom storm windows for 3-season porches. Geraths also provides installation also provides installation services for the windows. The installation process does not involve changes to the window, so the service can be performed by other vendors. The next one here, Geraths enters into the following contract on July 1st with a local homeowner. The homeowner purchases windows for a price of $2,400 and chooses Geraths to do the installation. Geraths charges the same price for the windows, irrespective of whether it does the installation or not. So the installation service is estimated to have a standalone value of $600. And the customer pays $2,000, which is a standalone selling price for the windows. Okay. So we'll call this the windows. Estimated. So over here again, so the installation service is estimated to have a standalone price of $600. The windows is estimated to be over here is to have the customer pays $2,000, which is a standalone selling price of the windows. Okay, so when I add these two numbers up, meaning this is really the full retail price, this gives me $2,600. However, how much is the customer actually paying us? Well, right here, it tells us that the customer purchases windows for a price of $2,400 and chooses Geraths to do the installation. Now, if this was my exam, I would say it includes the $2,400, includes both the, basically includes both the windows and the installation. I don't know if this is because the customer purchases the windows and gets Geraths to do the installation for a total of $2,400. So this $2,400 includes both. So just want to make sure that that's clear. Geraths charges the same price whether it does the installation or not. The installation service is estimated to have a standalone selling of $600, and then they pay us $2,000. Okay, and then because the windows have a cost of $1,100 upon delivery, remaining balance upon installation. So a few different things going on here, but I'll call this total retail. But however, we're only paying, basic customer pays $2,400, right? And the customer is going to pay basically $2,000 on delivery plus $400 upon installation. Okay, so we have an issue. The total amount of our retail price is greater than what the customer is going through and paying for this. So what I need to do is I need to allocate this transaction price. So over here, this is the contract. The consideration is $2,400. The performance obligations are really two. We're delivering the windows. And then in the second part is we're going to be installing the windows. And I'm calling this two separate events. Okay, this is very, very important. And one of the words up here is that the service can be performed by other vendors. If for some reason Geraths was the only one who knew how to install their Windows, I would not recognize anything until they had actually been installed. But we really have three different dates. We have July 1st, 2020, which is basically the contract assigned on 9/15 window, or excuse me, 9/1 Windows delivered. Customer pays 2,000, and then 10/15 is the Windows are installed and the customer pays 400. Okay, so that's really kind of what's going on. So now what we have to do is, because the value of the installation is 600 and basically the standalone price for the Windows is 2,000, we have to do an allocation. Why do we have to do an allocation? Because I can't recognize both of these on its face because this exceeds the transaction price. So how do I do the allocation? Well, there's a couple different ways we can do this. And this is why my 1B class seems to be really paying off right now. It's exciting. So my total is going to be 2,600. So what I now need to do is I need to figure out what my percentage of the total is. So I'm going to take right over here, 2,000 divided by 2,600. This is going to be 600 divided by 2,600. And when I take the total, so I'll call this A, B, A times B equals C, or sorry, A, so I've got, so this is my percentage of total, right? So I totally screwed this up, I'm sorry. So over here, I'm taking 2,000 divided by 2,600. Now, over here is my transaction price, which is 2,400. When I multiply B times C, this is going to be my allocation. So if I take 76% times 2,400, 23% times 2,400. So what this is telling me is I'm going to be allocating in terms of this price. I'm going to be allocating $1,800 to the Windows. So this total $2,400 price, I'm allocating $1,846 to the Windows, and I'm allocating $553 towards the installation. So again, because what I'm charging exceeds what the customer is paying, I need to do this allocation. Okay. So now what we need to do is, so we've talked about the performance obligations, we've identified the consideration, we've allocated that consideration to the performance obligations. Now we need to go through and recognize the revenue. So if I look at this here, my first date is 7/1/20. Okay, this is a sign of a contract, no action. There's no action going on here because there's been no cash that has changed hands. Let's now move over here to, and there's no real, it's just, will you be delivering Windows for us in the future? If the amount was significant and we were closing our financial statements at the end of the year, meaning that I had gone into a significant contractual commitment, you may have a disclosure issue, but that's for a different day and time. You can ask me about that in class. Okay, so now we're at September 1st, 2020. Okay, on September 1st, I got some cash. So I've received cash from the customer totaling $2,000. At the same time, I'm delivering the Windows. And because they can be installed by anybody else, I feel confident in recognizing the revenues as it relates to those windows. So I'm going to call sales revenue. And the amount of sales revenue I'm going to be recognizing is going to be this 1846. Now, my other issue here is I've got this little amount left over, okay? So to balance, I need right over here 153. So in this case, the customer is really paying me more than what I'm recognizing. So this is going to be unearned revenue. Okay, so there we go. Now, your book solution does this differently. They're showing cash of 2,000, accounts receivable of 400, and then unearned revenue of 553. But I'm doing this differently because I'm viewing the two distinctly. And the way I'm like looking at this right over here, that to me is a little bit more of a gross up. So I'm approaching this differently, but we're going to end up at the same result. As a reminder, whenever I sell product, I also have to take the inventory off of my books. So I'm going to debit cost of goods sold for 1,100, and then I'm going to credit inventory for 1,100. And this I would say to record sale of Windows to the customer. Okay. We're still on exercise 1010. Okay, estimate 1810. So the next step we have to do is what happens on 10, 15, 20. Well, on October 15th, the customer is paying us another $400 and I install the Windows. So here, I'm going to be debiting cash for 400 because that's what I'm receiving. At this point in time, I've gone through and I have basically, I'm going to recognize this revenue. And if we think about this over here, my services revenue that I need to recognize is going to be this 553. Okay, so right over here, this is my services revenue that I need to recognize is 553. I've received cash, and then at the same time, if I'm only receiving cash of 400, then how would I make this balance? It's going to be for this unearned revenue. Because I was recording this unearned revenue earlier because this is what related to that. This is what related to that one, basically to the service or the installation. So my description here will be to record basically performance of window installation. So, and again, if you compare this to the book solution, mine is slightly different because I do not debit accounts receivable, and I do not credit unearned revenue for the 553. To me, that's a gross up. Okay, so that is exercise 1810. Fun stuff. Okay, now exercise 1811 is also interesting. And why is it? All these questions are interesting. I love this book. So we've got over here, which you'll never hear me say about anything else. So refer to the revenue arrangement in exercise 1810. Repeat the requirements, assuming that Geraths estimates that the standalone selling price of the installation is based on an estimated cost of 400 plus a margin of 20% of cost. So how does that change what we just went through and did? Well, the only thing that's really changing is right up here. So when I take a look at this, and let's go through here and do. So now my installation is no longer 600. My installation is in fact going to be 400 plus a margin of 20% of cost. But as you can see here, I still have the same issue. My same issue is going to be that I still have the customer is not paying the full price. So over here, okay. So over here for my windows, this is going to be 2,000. This here will be 480. So this is going to be now be 2,000 divided by 2480. 480 divided by 2480. Okay, so when you all saw me doing the significant over under applied overhead from chapter 15 in managerial accounting, I think you now appreciate that we learned this. Okay, so here's my new allocation. So basically my installation price slightly changed, so this is going to be impacting what I'm going through and doing over here. So in terms of journal entries for this particular question, the only thing that's really changing here is going to be this part. So the inventory still has a cost of 1,100. The sales revenue now, instead of being what it was before, it is now this 1935. My unearned revenue is now 64. So that's when I record the initial transaction. So no difference from here from before. When I sign the contract, nothing's happening. There's no cash changing hands. On September 1st, I'm receiving cash, okay? So if I'm receiving cash here for $2,000, and now I'm basically saying, okay, my allocation has changed because my installation price is 20%, basically is 400 plus a margin of 20% on cost. So what that means is that the total selling price of this is going to be 400 times 20%, which is 80 bucks. So my total price or my selling price for the installation is 480. And then right over here, that's my new total. So this is what the fair price is. Then it comes over here. So I'm basically recording that as unearned revenue because I'm only recognizing the sales revenue up to the amount of the windows. Over here, cost of goods sold and inventory. And then down over here, I have cash and then unearned revenue and then services revenue. So at the end of the day, right, I've gone over here, and this is a great way to check your work. When you're talking about your total amount of your revenue, it needs to be 1935, 464, which is the total of the 2400. And we need to be using those other holding accounts while we're going through and doing this. One of the other things that you'll notice over here is that with cost of goods sold and inventory, that's how I get that inventory off of my books. Okay, so there's now this final part over here, which is given the uncertainty of finding skilled labor, Geraths is unable to develop a reliable estimate for the standalone selling price of the installation. So what this is interesting about this is basically saying, okay, if you can't come up with a selling price, then just go essentially based on what the contract is going to be. So over here, and I'm going to pause really quickly. So if I can't come up with an estimate for the amount of the skilled labor, then what I'm going to do over here is I'm going to use what they call the residual approach. So what you see here is basically here for part B, and this is sounding like a great question to ask all of you on the exam. It's going to be a great question. We're making accounting great again, MEGA. That's really what it stands for, is make accounting great again. And so we're going to go through and let's make this great again. So this is something called the residual value approach. So if I know that the windows basically sell for 2,000, and then over here my installation, if I am unable to estimate what this is, and my total customer price is 2,400, this residual value approach would then be, it's like, okay, it's going to be customer price, which will be 400. This will be the customer price, which is 2,400 minus the of 2,000. This is going to be 400. So this is going to give me my residual value over here of 400 bucks. So in this case, what I would be doing then, if I took the same approach and strategy for this, I would be going through over here and saying, okay, cash is 2,000, but my sales revenue is now going to be 2,000 as well. Because here I could not go through and recognize that because I can't figure out what this is. I'm just going to go ahead and assign it. And when I assign this, I don't need to do this ratio calculation. So here it is, basically cash services revenue, cost of goods sold inventory, cash base services, cash sales revenue, and then this is cash services, not review revenue. So there we go. So that's this one particular question. I actually really like this question. It's very interesting. So something for you to take a look at on those all that free time that you have. So I want to thank you for joining me here today, and I look forward to seeing you on the next video. Have a great one.